If you've been trying to buy a home in California, but you've been struggling to save up for a down payment, then this video is for you. Because California just recently announced that they've released a brand new down payment assistance program that is giving home buyers up to 10% of the purchase price in the form of a forgivable loan. And so in this video, I'm gonna be telling you guys everything that you need to know about CalHFA's brand new Equity Builder down payment assistance program, what it is, who qualifies, and how you can use it to buy your first home in San Diego. Coming up. What's up guys, welcome back to the channel. My name's Keitan. I'm a loan officer from San Diego, California. And on this channel, I help people just like you learn how to buy their first home and build wealth with real estate. So if you've been following me for a while on this channel, I've kind of talked a little bit of smack about some down payment assistance programs, specifically the ones here in California. And that's mostly because a lot of these programs aren't forgivable. They'll give you the money, but they're gonna want that back eventually. But it looks like somebody over at the California Housing Finance Agency might have watched one of my videos because they just recently announced a brand new down payment assistance program that they're calling the Equity Builder. And not only is this a great down payment assistance program offering up to 10% in down payment assistance program, which is basically triple of what they usually offer, but on top of that, it's coming in the form of a forgivable loan. Not a true grant necessarily, but something that is forgiven if you live in the home for a certain period of time. Now, before we get started, if you are thinking about buying a home in California this year, I'd love to get in touch with you. You can check out a link in my description to book a one-on-one consultation. It's completely free. I just want to help you guys learn what it takes to buy a home here in California. Alrighty, for starters, this loan is offered through the California Housing Finance Agency. They're not a lender, they're an agency that kind of offers some of these down payment assistance programs and gets lenders approved with them to offer these loans. They offer a mix of great down payment assistance programs that are paired with your traditional conventional FHA, VA, and even USDA loans. So it's definitely worth checking out if you're trying to use any one of these types of financing. All right, so let's start with who is an eligible buyer for this program. According to CalHFA's guidelines, they have a requirement for this particular program that all people borrowing and co-borrowing must be a first-time homeowner and must also occupy the property as a primary residence. So unfortunately, this means you can't have any non-occupying co-borrowers. For example, if you wanted maybe mom and dad to co-sign with you to help you meet some of the guidelines, unfortunately, they are not going to be able to unless they also plan on living with you. And of course, the stipulation is all co-borrowers must be first-time homebuyers as well. So anyone that is co-signing on the loan, anyone who's going to be living in the home must be a first-time homebuyer. On top of that, all first-time homebuyers that are using this program must complete a CalHFA approved homebuyer education course. I'll leave a link to the courses that are actually approved underneath. I think they're great resources in general anyways. Some of them are free, some of them are paid for, but it's worth checking out. Also, anyone buying the home must occupy the property as their primary residence within 60 days of closing. So this kind of gives you a little bit of time to kind of move in if you need to fix up the home a little bit. Got a little bit of time, but you've got to occupy the property within 60 days. All right, now as I mentioned, this loan is a forgivable loan, which is not the same as a grant, which a grant is just money given to you. It's basically like a gift. But a forgivable loan means we're going to loan you this money at 0% interest actually. But if you meet our requirements, you get forgiven after a certain period of time. All right, so how does this loan actually work? For starters, it has to be paired with either a conventional FHA, USDA, or VA loan offered through CalHFA. So those rates are set by them. It's not like you can go to your own outside lender, go get the first mortgage from them, and then pair it with CalHFA's Equity Builder loan for the 10% down. You have to use them for both mortgage products. And because you have to use one of CalHFA's mortgages for the first mortgage, that does mean that you're limited based on those underwriting guidelines for those specific programs. For pretty much all of these, that means there's a hard cap on the debt to income ratio of 45% or 43% if you're using manual underwriting. This also means to qualify that you're going to need at least a minimum FICO score of 660 for conventional products, and for government loans, that's your VA, FHA, and USDA loans, the minimum FICO score is going to be 640. But those are just general guidelines for their first mortgage programs. Let's talk a little bit more about this particular one, the Equity Builder, the 10% down forgivable loan. First of all, what is that 10% based on? Well, according to their guidelines, the 10% is going to be based on the lesser of the sales price or the appraised value. Now, this is a big deal because in this market, there's a lot of situations where buyers are bidding on homes and the price that you're under contract for might not be what it appraises for. And a lot of times homes are appraising for a little bit less than what you're under contract for the sales price. So it is important to know that if you are planning on using this program, you want to make sure you're doing your research early on the comparable sales to make sure that appraisal comes in at value if you're planning on relying on all of those funds. So for example, if you were under contract on a home for $400,000, but the appraisal came in at $380, the down payment assistance from this, the 10% would be based on that $380. So you would get $38,000 not 40. Now, here's the thing that most people are probably questioning on this program is how is this a forgivable loan, right? You're borrowing money, but how is it forgiven? Well, for starters, the loan is technically a 30-year loan at 0% interest, but it is forgiven if you meet the requirements, which is really just occupying the home for the first 5 years. Now, I looked up the guidelines and it isn't particularly clear if that's a continuous 5 years or if that's, as a primary residence, you gotta occupy it for your first year as your primary residence. Then after that, since it's a 30-year note, maybe you go on and off, and once you've occupied it for a total of 5 years, that might be the case. But my working understanding, if this works like all the other kinds of down payment assistance programs that are forgivable, is you have to owner occupy it 5 years first, and then you can move out and then it's forgiven. Now, what happens if you don't make it to that 5 years for whatever reason? If you have to sell, if you end up trying to refinance the loan, maybe you want to rent it out, or maybe, I don't know, you default on the loan. What happens then? Well, once again, according to their guidelines, it's going to be forgiven on a prorated basis in the event that it becomes payable. So the things that would trigger it becoming repayable would be if you sold the home, if you transferred the deed or the title of the home to somebody else, if you wanted to refinance the first mortgage or paid off the first mortgage in full, then it would become due. And of course, in the event that you defaulted on the first mortgage, then the forgivable loan would become due as well. But as I mentioned, it's prorated. So based on how much you were given divided by 5 years, you basically get prorated on a yearly basis. So let's say, using round numbers, you got $50,000 from this program and you lived in it for 2 years and decided to refinance the home. You wouldn't have to pay back the $50,000. You'd only have to pay back $30,000 because there were 3 years left. Honestly, this is pretty in line with the same kind of down payment assistance grant that GSFA offers. So I like it. It's a little bit longer. GSFA is 3 years. This is 5 years, but it's more. This is a lot more. GSFA offers up to 5% of the loan amount, whereas this program offers up to 10% of the sales price or appraised value, which is a lot more money. All right. By now you're probably thinking this all sounds great, but you're waiting for it, right? There's gotta be a catch somewhere. And the catch is it's got a pretty strict income requirement. The California Housing Finance Agency has their own list of income requirements for each county in California. And honestly, these income limits are pretty forgiving, but for this particular program, they've decided to not use their own income limits, but instead they're using Fannie Mae's AMI tool, Area Median Income tool, to determine the maximum income limit. So for this particular program, your household income has to be less than or equal to Fannie Mae's 80% AMI, which for a lot of counties, that's a very restricting amount. Just for an example, if you were using 80% of CalHFA's income limits for San Diego County, the income limit would be over $150,000. But using the AMI tool from Fannie Mae, that income limit shrinks to just over $76,000 a year. So essentially, you're trading half of the buying power for 3 times as much down payment assistance, but let's see how that translates to real life. So I pull an example from my neighborhood. I live in Chula Vista, and the AMI, according to Fannie Mae's website, is just a little over $76,000 a year for that 80% mark. So using CalHFA's guidelines, that means my maximum DTI of 45% means my payment has to be just over $2,800 a month, and I have to have basically no other debt than that in order to qualify for this. Now, as of today, if I was going to use a conventional loan through CalHFA, the rate for a 30-year fixed would be 5.75%, which honestly isn't that bad considering where market is today. But once you start trying to do the math and trying to figure out, okay, how much home can I afford based on these requirements, the reality is if you were to use this program, the maximum home you could qualify for would be $425,000. Now, while that sounds great, the market has been on fire lately. And I looked at all of San Diego County, and there's literally just one home for sale for under $425,000. Now, mind you, San Diego has a fairly high income level. So as you go to different areas in California, the AMI ends up being a little bit less than that, or even a lot less in some places. So while I do like the fact that this is a 10% down payment assistance program that's forgivable after 5 years, biggest thing that's going to hurt people from actually being able to use this to buy a real home in California is going to be the fact that they're using the Fannie Mae AMI calculator versus their own. The reality is, throughout California in general, there just aren't enough affordable homes that meet the guidelines of this program and that have the AMIs, the area median incomes, to be able to afford these mortgages. Now, while these are the guidelines as of today, this is a recently released program. CalHFA has been known to make changes and adjustments to their program over time. At the beginning of COVID, they got a little bit more conservative, but then they started opening it up a little bit more and obviously releasing new programs too. So I would hope that over time, they start realizing that not a lot of people are using this program and maybe start opening up those income limits, maybe going away from Fannie Mae's and going towards something a little bit more aggressive like their own. Ultimately, I think this is a step in the right direction for CalHFA, but I think they did miss the mark a little bit when it came to that income limit. They have to realize that the prices of homes don't really meet the AMIs that are based on that calculator. So I hope they make some changes to this program and maybe even roll out some more programs kind of like this. I think the fact is California has a lot of money, and the fact that they're able to offer some more programs to help people to kind of close that home ownership gap, I think is going to be very, very important. But also kind of understanding where people actually are versus where the numbers are is a place where I think there's a little bit of a disconnect there. In conclusion, I think this is a solid loan for you if you qualify, if you manage to find a home that meets their fairly stringent guidelines when it comes to that AMI requirement. I think this is a step in the right direction from CalHFA. I think this program has a lot of potential to help a lot of people, especially people like you watching this video who are trying to buy their first home in the great state of California. But if you learned something new today, make sure you hit that like button. It really helps my channel grow. Hit subscribe if you want to find more real estate content that's going to help you buy your first home this year. So I'd love to know what your guys' thoughts are about this new down payment assistance program from CalHFA, the Equity Builder Program. Leave them in the comment section down below. I'd love to hear your thoughts. Otherwise, here's a few more videos that are going to be super helpful for you in your home buying journey this year. Until next time, bye.